All right. Once again, welcome back to accounting. So again, now this subject, so chapter 9, we got to see what happens when we deal with cash or, you know, involving cash. Then we got to see what happens when we involve with receivables, how to complete a bank reconciliation, what happens when we get a loan and we have to calculate the time value of money. Now in this case, we're done with money. We don't need to know about money anymore. So we're going to be moving on to another asset, which is going to be more so or less for fixed assets, okay? So when we talk about fixed assets, right? When we purchase our fixed assets, normally it's kind of tangibility to it, but also that a fixed asset usually has a life longer than a year. Now, of course, when we talk about fixed assets, right? It's either going to be something that's either a property, plant, or equipment, right? Property meaning land, the streets, the buildings. Not the buildings. The streets, the sidewalks, the parking lots. Those are all going to be considered property. Okay, where plant is going to be the building, and everything that's inside the building. So furniture, lamps, fixtures.
Lynn,
Yes.
you have something on the top of, sorry, you have something on the top of the screen and I can't see the full screen.
No worries. One of those criteria is whether it's a property, plant, right? Plants, everything inside the building or buildings itself. And I'm sorry, give me 1 second. Okay. So, yes. And then again, we talk about equipment. Anything that helps the business operate, like any machinery, any types of ways to be able to produce an item or something like that, right? That's going to fall under equipment, right? Things like a cash register that helps us process the sales procedures, right? So those are going to be factors, and usually those kind of things have some kind of tangibility to it, right? You could definitely touch a building, you could definitely touch a street, you could definitely touch a machine. And the second component is that it has some form of life. Now, when we talk about a life, right, what does that mean? Usually, give or take, let's say you buy a refrigerator, right? On the box, or usually they'll have like a market to you. Oh, if you buy this refrigerator, it should last you for 15 years without any warranty, something like that, right? And that means that, after 15 years, it should eventually start giving up and the circuits inside the refrigerator doesn't work anymore, or something in the machine doesn't work anymore. And that's when it means that it's given a life. Now, when we talk about actually depreciation, well, what is depreciation? Well, when fixed assets, right, because it has a life, right, we have to understand that as we use the machine or as we use the building or something like that, right, we notice that the more that we use it, eventually the item becomes old, obsolete, or et cetera, et cetera. Now, in this case, we're talking about fixed assets. So again, furniture, right? A couch. If you sit on it so much, right, you're going to get wear and tear on it. Maybe the cushions in there are so molded that you can't actually sit in it anymore. So when products become like something like that, become old or obsolete over a period of time, we need some kind of way to measure that. And that's what we use depreciation for. Now, depreciation is going to be considered a non-cash transaction because in this case, right, it's kind of hard to kind of follow along, but when we deal with fixed assets and because there's a price value to it, right, we can't necessarily say we're spending it or using it, right, on paper because, when we understand the rules of accounting, when you buy an asset, you cannot devalue it. You cannot change its value due to the historical cost value. So the best way to do that, because we're doing an accounting way, is to depreciate it until the day that you actually sell it. Then you would market it at its fair price value. Now, in this case, if you want to understand it this way, depreciation is a way to record that you're using the asset. Okay? So, a great example is that, again, when you buy a printer, right? The minute you plug into the wall and you print stuff, it's already being used. So, if you think that you can take that printer and be able to sell it right out to the market, you know that whatever price that you paid for it, you can never get at that price value because you already touched it, you already used it, you already, printed something out of it, you used it. So think of it in context of that, where when you use a fixed asset, it's not going to hold its value over time. And that's where we also have to understand this too. So it's very similar to inventory adjustment. However, in this case, right, when you depreciate stuff, you're essentially representing that you're using it versus where inventory, right, when you purchase it over time, there's newer models, so it just gets ended up being replaced. No, in this case, when you use the fixed asset, it just decreases in value over time. Right? Now, let's talk about depreciation. Well, in context, right, when we talk about depreciation, depreciation is for any tangible asset, okay? So it's mainly for fixed assets, which are usually have, a physical feature to them, right? You can actually touch them. So again, over a period of time, fixed assets actually are being used and they lose their value over time. Which we talked about already. So especially during productions or during, business operations, right? If you open up your shop, people are going to use your furniture. People are going to spill, for example, if you buy a coffee table and people keep spilling their drinks on there, eventually the table starts lifting up or things like that. Then it becomes damaged. And then that's what I mean by using the actual item. So a good example would be anything like computers. Computers usually have like a 5-year lifespan, or depending on how good quality or good condition you do to it, it should last you longer than that. Furniture, trucks, buildings. Now, here's something that you need to know. Land is considered property, right? It's considered a fixed asset. However, in accounting, land is actually going to be one of those special fixed assets that can never be depreciated, okay? Because it's true. Think about it. Think of it in retail perspective too. When you have a piece of land, can you depreciate it? Can you make it lose its value over time? Well, in accounting context, no. Your land will never be zero, okay? But in reality, right, more in advanced levels of accounting, you're going to realize that land, it actually holds a lot more than just value. It holds natural resources, right? When you have natural petroleum gases and you have to dig it up, right? Natural carbon, if it's down, if you could dig it up, then that's what it means that you can actually devalue the land by saying, like, for example, if this land is a minefield for diamonds, okay, and you take all the diamonds out of it, then that land is no longer valuable, okay? And in a more advanced level accounting, we call that depletion, okay? It's okay, when we dive into chapter 11.4, there is an actual different terminology for each type of asset. So for example, depreciation is for fixed assets, depletion is for land, and then we're going to learn about amortization, which is actually for intangible assets, right? But essentially, all three of those terminologies are the same thing. You're just using the asset, or somehow you're trying to decrease the value over its lifespan. Okay, so in this case, because we're looking at only depreciation in this section, we are only focusing on fixed assets. Okay, and so remember, land cannot be depreciated. Okay?
Land can increase its value too, no?
Okay, so when it comes to property, real estate property, yes. But in accounting, no. You can never add a value to land. Okay? The only way that you can add it if you sell it and purchase at a higher level, then yes. But in this case, no, you can't physically add money to a land. Okay, even if let's say you build a theme park on that land and you're generating revenue. No, that doesn't increase the value of the land because the land again follows the historical costs. If you bought that land for $100,000, it stays at $100,000 until you sell it. But then if you sell it, that land is no longer yours. You end up treating it for money. So at the end of the day, you cannot increase the value of any asset. And that's the rule here. Okay? So in property management, of course, right? For example, like a lot of homes, right? Because they're on such rich soil, their value of the house goes up in price. In this case, no, whatever you buy it at it stays the same way no matter how many fixtures you add to it. It's only until you sell it that's when you gain a profit, but you don't ever recognize it being, or you can't value it at a higher level. Okay. Okay. So when we talk about how we actually calculate the depreciation, we have to understand that it is the underlying rules that back up depreciation is GAAP, right? We talked about the historical cost, right? Where historical cost is what we price our assets at. Usually, this rule states that when we purchase our fixed assets, we record it at its fair market value or whatever price that we purchase it at. However, we cannot change the value of it. We cannot increase it, decrease it. We cannot change its value unless we sell it. Okay? But in this case, right, there is a section where it says how you dispose fixed assets, right? That should be the very end of the chapter 11. I'm not going to talk about it in this chapter, but if it's definitely something that you want to read to learn how goodwill is created, okay? And how the process of selling your fixed assets, whether you have a gain or a loss, it's in that small section. Okay? But in this case, we're just focusing that we need to recognize our fixed asset at its fair market value for whatever that you purchased it for. You cannot increase or decrease the value, and assets can only be revalued if you extend its useful life. Yeah, that's the only thing that you can do. You can, like for example, a machine needs maintenance. Of course, when you do maintenance, it extends the life of the asset. That's the only time that you can actually revalue it. Okay? And of course, matching principal, meaning whatever amount that you purchased the fixed asset for should overall be equal to the expense. So again, depreciation is considered an expense. So when we depreciate a fixed asset, right, the way that we match it is that, okay, well, if my asset is worth X amount of money, that means at the end of its life, you should exhaust every single penny. That means the amount of that fixed asset that you purchased it for should match the total depreciation expense. Okay. And now we're going to dive into the 5 components of what depreciation is. So the 5 components consist of number 1 being the cost of the asset. Okay, number 2 is going to be the estimated useful life, or also known as the expected use for production. Okay. Then third thing is going to be salvage value or residual value. Fourth is going to be understanding what or when did you place this asset into service. And then last but not least, depreciation method is going to be, well, which one are you using? Okay. So let's dive into the first component here where we're actually looking at our total cost of the asset. So in this case, right, the definition for the total cost of the asset is going to include every single cost it takes to get the asset ready for service. Okay, not to your door, but get it ready for service. Okay, so that can include number one, obviously, the actual selling price that you purchased the asset for, right? Tax if there is any, right? Any product fees, any installation fees, shipping and handling, of course, even training. If you need to train somebody to use the machine, right? Because it's maybe it's a very expensive machine and needs a professional to be able to operate it, then there you go. That's going to be considered something that's going to be included the cost to get it ready for service, right? You need to spend money to train somebody to be able to operate it, okay? And then, of course, if there's anything like that, installation fees, etc., right? So the idea is for inventory, it's everything cost it gets to get the inventory to your store. Fixed assets is going to be everything that you need to get the fixed asset ready for service. So not to the store. If you need to do extra fixtures to it, then just to get it ready to be able to operate in your store, then that's going to be included in that cost. Okay, and we're going to see an example in the fictitious business coming up real soon. Okay. Then the second component is going to be the estimated useful life and salvage value. So I'm going to go ahead and talk about these two components at one time because it's also broken down by the rules of whether Gap and the IRS oversees it or if you are a sole proprietor. Because sole proprietors actually get a few they get a little few leniencies to this rule. Okay. So let's talk about the estimated useful life first. Okay. So under the rules of GAAP and IRS, since they are primarily geared towards major corporations, right? They tell you that the estimated useful life is already predetermined. As in, you don't need to do any research. It should be something that's already predetermined. All right. And what does it mean by predetermined? So usually, typically, they have something that's similar to like a Blue Kelly book for cars, right? Where you can check up the car model, item, color, whatever it is, right? Brand. You can look at that and it will tell you the price value of it. That is similar to this. In this case, instead of telling you the price of it, it will usually typically tell you how long each asset can produce for you, okay? Or what's the life of this asset. In most cases, if you did not know, by law, any electronic that you buy, they have that information written in on top of the box. It's written in fine print. It's usually one of those little descriptions that it says, like usually anything that has a warranty, they have a lifespan. They have the product lifespan on the actual box of the actual item that you buy. Right? So in that case, right, if you're gonna go, but if you are gonna go through the IRS or GAAP, right, your numbers that you should remember is 5 and 7. Okay, 5 is typically any type of electronics, so anything that's a computer, a printer, or a register, that will typically fall under 5 years. Okay, where something like 7 years, right, could be any machinery, any like full-on equipment, furniture, desktops, right? Because they are a little sturdier in nature, right? Where electronics, right, as we know, electronics, they tend to give out a certain amount of time because due to the electricity flowing into it, it can damage the property. Now, of course, again, with nowadays, I believe even cell phones or even even like electronics like those that people frequently use so often can even have a shorter lifespan of 3 years. Like I believe a laptop only actually has a span of 3 years, depending on how much you use it. But if you're using it every single day, it's probably gonna last. It's probably gonna last you less than 3 years. Okay, especially like iPhones, right? Every year you want to trade your iPhone, right? Then you barely used your phone. But for someone like me who still has the iPhone 6, it still works, right? It still works. I can still make phone calls. I can still take pictures, right? I can still use the internet. It still works because even though it's something I use for so long, it has that tendency where it lasts long because it falls under the category of it should last you more at least 5 years. Okay. And then, of course, when we talk about salvage value is basically at the end of its life, does it hold a value over time? So in this case, right, all assets are under IRS and GAAP. They actually tell you this. They say that all assets, when you depreciate them, should not hold any single value over time. So once it's reached its end of its life, that's it, it's zero. Okay, so a good example will be a truck, right? Or a car, right? We buy our cars at like what, roughly around $25,000, but we know for a fact that after it's like been 5 or 6, 7 years, we know for a fact that it still's got scrap metal value, right? We know we could trade it in for at least $5,000 because we barely used it, or it still runs, right? The motor works just fine. And it's gone through a lot of maintenance. And because of the rules of GAAP and IRS, they don't want you to overstate your assets. So when you are going into like a corporation, you do need to follow these strict guidelines that you cannot have a value of the truck, right? Because the assumption is when you buy it, you're going to use it to the ground. As in, you're going to use it so much that it shouldn't have any holding value on it, okay? So the difference between that and a sole proprietor is, once again, a sole proprietor or a small business, they have leniency, right? Or they have a few things that they can get away with. And that will be determining the estimated useful life, okay? Now, of course, they can't just stack on a random number on there and say, hey, I bought a printer, it's going to last me 20 years. No. It doesn't work that way. However, when you, the thing about sole proprietors or those type of businesses, right? They're not using their assets at a grander scale as a corporation would. Right? It's not like it's an office where it's printing 25,000 pages a day. Okay? This is a small business. Maybe they're printing only 10 or 20 pages a day. Right? And that's what I mean. That is why smaller businesses have a little more leniency over this, because they get to establish their own estimated useful life. Obviously, with a few context as well. They can't, like I said, you can't just slap on a number and call it a day. No, it does have to do with intense, research. For example, so if they bought a printer, right? And let's say they only print maybe 10 pages per day, right? So on average, they don't print that much. So in this case, their printer can last them longer than 5 years because they only print it here and there. They don't turn it on all the time, or they don't keep it running all the time. All they have to do is just swap out the ink. Everything looks fine because just the way that they're using it will never reflect like a corporation where they have like bunch of fax machines that's just shooting paper out. No, in this case, it's okay for a small business to be, well, Realistically, if I'm only printing this many pages and the box says that it can print out up to this many pages and it should last you 3 years, but in this case, since I don't use my printer so often, if you do your research and maybe you can get it validated to actually last you 10 years. Okay? So that's that right there. Whereas same thing with salvage value, because the idea here is that because you're a smaller business, you wouldn't use the machine as often as a corporation would. So therefore a salvage value could be possible, right? Especially for a truck. Especially yeah, if the small business buys a truck, they're just driving it here and there. They're not. It's not like they're driving across the United States 4 or 5 million times. No, they're only maybe taking it out to a local shop to go get to deliver stuff to a city, whatever. It's to the minimum. And of course, with this, right, especially this, you definitely want to make sure that you don't, exhaust all the money that you have, because as a sole proprietor, the way that they look at assets, of course, they want to hold on the value of the assets because it reflects the value of the company. Where the corporations, it doesn't matter how much money they make their money off of other people, right, by buying into stock. So that makes them how consider their net worth. Where ours is where small businesses, they have to earn it by having all of these items, okay? So with that being said, for small businesses or sole proprietors, you guys can have the opportunity to go ahead and have a salvage value available for an asset. Okay. Oh, any questions there?
Nope.
All right, so then we're going to talk about date that you place it into service. Okay, this is very important because, again, when we look at an asset's life, right, it's just like children. Okay, the day that they're born is going to be the day that you start counting their life, right? If a baby was born in October and it's already fast forward December, right? And it's only 3 months old. Okay, and same thing here. If an asset is to be placed into service in October, and at the end of the year, then the asset's only 3 months old. So it's the same thing that rules applies here. However, there's a little more extra information here, right? And the extra information is that it depends on the actual date you actually place it into service as well. And we'll talk more about what it means to what happens when you have these specific dates, right? We'll talk about what partial years is. But in this case, right, if it falls between the 1st and the 15th, right, you place it, let's say you place it into service on June 8th. Therefore, the assumption is that you've been using it for more than half the month. So therefore, you're going to treat it like you are going to depreciate it for that month. Okay? Where if it falls between the 16th and the 31st, right, that barely covers half of the month. So that means you barely used it for that month. So in that case, if you barely used it for that month, the best way to do it is you're going to ignore the current month and just and then go ahead and start depreciating it the following month. Okay? So again, this is in context of how much of a month did you actually use. So in this case, right, if I put it into service on June 4th, that is definitely more than 50% of the month. So therefore, you're going to start depreciating in the month of June. But let's say you put it into service June 24th. That's only 1 week left in the month. So that's me constituting as I barely used it for this month. So what I'm going to do is I'm going to depreciate it starting the month of July. Okay. And this is very important because once again, when we treat our assets like they're our children, right? The lifespan of an asset actually lasts a lot longer than if you're just using a regular calendar year or your fiscal year, right? You're not counting based on the months that you used it, in this case, we're counting it the month that you actually place into service. So we're counting the months that we use it versus the whole year when we only got it for half a month. Okay. Okay. And again, we'll talk about partial years in this section. Okay. And then last but not least, we're going to talk about the different types of depreciation. So again, as you can see, there's about 6 or 7 different types of depreciation. Now in this class, of course, I would love to be able to go through all of them, but realistically, we're looking at a small business. So the other ones are they're more complex and more for, businesses that, businesses that has more than one fixed asset, let's say, or has a bunch of fixed assets that are, priced valued at a really high price point. Whereas a small sole proprietor, your expenses or your fixed asset is not going to be as extensive or as expensive. So in this case, right, the ones that I'm going to teach you is going to be activity-based depreciation, which is also known as units of production. We're going to teach you depreciation method for straight line. Okay, so straight line, and then we're going to teach you accelerated, or also known as double declining. Now, again, depending on what company you go to, you can learn them as either or. So accelerated is the same thing as double declining. Activity-based is the same thing as units of production. But straight line, it's pretty straightforward. It's the only one that they have. Now, again, in the IRS, right, they commonly would strictly only have you only use either straight line or double declining, okay? Because it's the simplest and easiest way to calculate depreciation, but it's also a way so then when you depreciate it, right, instead of having to calculate every single month or every single year, it's just one number and one number only. Okay, so they commonly use that one a lot more better because, again, it makes it easier for the IRS to be able to look through the papers and be like, aha, that's correct. Okay. So again, we're only letting 3 out of the 6 that are listed here, just because of time's sake, but also these are the common ones that you should know anyway, right? Some of the years you don't need to know. Group, you don't need to know, right? Or a combination, you don't need to know. So because today is 11.1, we're going to take a look at the very first depreciation method, which is called activity-based method, or in this case, we're going to learn it as units of production. Okay. So when we take a look at the formulas that are associated with depreciation, these are it right here. You'll also be giving in context details, of course, right? You'll be given those 5 components, and what you're going to do is you're going to use these formulas right here to help you calculate the depreciation for that particular scenario. So in this case, when we look at activity-based or units of production depreciation, what we're actually doing is we're actually looking at an asset and basing it off of its total amount of units that it can produce. Or in this case, I normally refer this as a capacity, okay? So every machine has some kind of capacity, and once it reaches capacity, it starts to break, or it starts to need maintenance, or it might need to be replaced a few parts. So for this instance right here, right, a printer, right, always on the box will tell you it can print up to 100,000 pages. Okay, once it reaches that 100,000 pages, then it's going to either need ink, need to replace the wheels, et cetera, et cetera. Okay, it needs maintenance. All right, and that's what we're doing here, is that when we're learning the depreciation method for units of production, we're basing it off of the amount that it can produce. And so that's where the formula, depreciation basis, right? So your cost of the asset minus salvage value, But when we dive right into the per unit rate, we're actually taking the depreciation basis and we're going to divide it by the total of number of units that it can produce. Okay. So again, they're gonna visit each and every single one of these depreciation calculations. So let's go ahead and dive into our example here. So it says right here, record the depreciation for the first year. Okay, there was 2,100 units produced for the first year. So in this case, right, we have an asset. It's a machine, okay? And this machine costs a total of $15,000. Its salvage value is $2,500, okay? And its useful life is 5 years, and the number of units that it could produce is up to 10,000 units, okay? And the date that you place it into service is as of January 1st, okay? So let's take a look at the very first context of this, okay? Let's solve one at a time. Now, there's a difference between units that it could produce and then the units that it could produce that year, okay? So it says that first year, it only produced 2,100. Now, let's go ahead and take a look at our formulas, okay? First formula we have here is going to solve for the depreciation basis, which is the cost of the asset, which is 15,000, minus salvage value, which we know is 2,500. So that means my depreciation basis is going to be 12,500. Okay? So the next step here is going to be solving the rate. In this case, the per unit rate is going to be the depreciation basis divided by the total number of units that it could produce. So in this case, right, my depreciation basis was 12,500, and if I'm going to divide it by my capacity, right, so the total number that it could produce is an overall 10,000 units. So what I'm doing here is I'm getting a per unit rate, meaning that every unit that I produce, it's going to cost me some money. And that's exactly what we're doing. We're figuring out how much, if the capacity can make a total of 10,000 items, then how much is going to be one item that I produce? How much is it going to cost me? Or how much am I going to measure that to depreciate as part of my units of production? So in this case, right, we're going to take my 12,500 and we're going to divide it by my 10,000 to get me a total of 1.25. So $1.25 each item that I produce, that's what's going to cost me. It's going to cost me $1.25. Okay? So then the next thing is going to be the depreciation expense, where you're looking at the number of units you produced that year and you're multiplying it by the per unit rate. So in this case, right, I have a grand total that I can produce is up to 10,000 units, right? And if it's going to cost me $1.25 for every unit I produced, right? Now I'm going to take a look at how many I produced that year. I produced a total of 2,100 units. So therefore, I need to figure out what my depreciation expense is, and you're just going to calculate your depreciation rate, or the per unit rate, times the total number of units produced that year. So in this context, it's 2,100 times $1.25 to get you a total of $26.25. Okay? And then the next part is where you're going to solve for your book value. So you know what your asset should be worth at the end of producing all these amounts, right? After using the machine, right? This is how much it's going to reflect its value currently. So in this case, my depreciation expense is $26.25, right? My accumulated depreciation is going to be my previous year's accumulated depreciation plus the current year's depreciation expense. In this case, since I'm starting depreciation for the first time for the first year, it's that means I don't have a previous accumulated depreciation. However, so that is if I don't have one, then it becomes zero. And what is zero plus the current year's depreciation expenses, in this case 2625, therefore my total amount is going to be 2625 for my accumulated depreciation. Okay? And then last but not least, we need to solve for book value. Book value is going to be the cost of the asset minus the accumulated depreciation. So in this case, what was the cost of my asset? It originally cost me a total of $15,000. And I'm going to subtract the 2625 from that to get me my book value to be a total of 12,375. So that means if I go out and I said, hey, I don't need this machine anymore, and I try to sell it out to the market, I obviously can't sell it for 15,000, but at least I know by devaluing it like this, right? My asset is at least worth 2,300. Now, of course, again, when you do sell your used assets, oftentimes you actually get a lot less than what it's actually worth. But, at least you get something out of it, right? So, at least it's worth 12,375, okay? And that is how I calculate depreciation. Okay? Any questions?
No.
Okay. So let's go ahead and do the example for the second year. Okay. So if for the second year, let's say I end up producing 2,000 units. Okay. So therefore, let's see. I have to solve for my depreciation basis and my depreciation rate. So once again, my depreciation basis is going to be the asset cost minus salvage value, which in this case, 15 minus 2,500 gives you 12,500. And then the per unit rate is going to be my depreciation basis divided by my total number of units that Kitty can produce, which is 12,500 divided by 10,000 to give me $1.25. So notice this, okay? As I fill out my information, right, here's my depreciation for this year because now I know that 2,000 of those items times $1.25 is going to give me now 2,500. And of course, my accumulated depreciation, once again, is going to be your previous accumulated, so 2625, plus my current year, which is 2,500, to give me a total of 5,125. Okay, 5125. And of course, book value this time is going to be your asset cost minus your accumulated, which in this case, right, you're going to take your 15,000 and you can subtract the 5,125 to get a grand total of 9,875, right? And of course, so on and so forth. So what you actually notice is every time you keep calculating, notice this, that the total number of units that you're producing every single year, right? In this case, right, if you total up this whole entire column, it should give you your total capacity, which is your 10,000, okay? Where you notice this, your depreciation basis and your rate, per unit rate, actually end up staying the same. Because no matter how many times you calculate it, asset cost minus salvage value, you're still going to get the same answer. So in this case, once you solve for one, in this case, you at least know what to expect for the next one, okay? And the only difference is that every time you calculate your depreciation expense, obviously depending on how many, the number of units you produce that year, is going to determine the difference between the expenses, the depreciation expenses, right? At the end of 5 years, you should notice something else too, that it should equal the depreciation basis that you had earlier, okay, that you calculated earlier, okay, which is the 12,500. So at the end of the 5th year, it should equal 12,500. And again, your book value should end up looking like this, where You enter in all the formulas, which is the asset cost minus the accumulated depreciation, and eventually you'll get to a total of your salvage value. Right? Your salvage value is 2,500. So there you go. At the end of January, it is 2,500. Okay. Any questions here? Nope. Okay. So what happens? Okay, so then what happens if year 5 that you end up your machine end up producing a total of 2,200 units? Okay, let's just say theoretically. Now, of course, every machine can go beyond its capacity, right? It's possible, right? Maybe the way that you have the settings on there allows it to be able to produce a few extra. Obviously, the more you go over the capacity, the more likely that you're going to have defects in the products, right? Especially when it's already running at its end of its life, it starts to break down, and then it ends up producing the products, but it ends up producing broken products. And you definitely don't want to do that. But in this case right here, who's that? Hold on. In this case right here, okay, all right. In this case, right, we're taking a look at what if this was one of those machines that end up making its capacity. Run it through. So let's say we calculated it was 2,750, and then 2,750. Or 12,750, and then it ends up with a book value of 2,250. Okay. Unfortunately, we also have a rule here. If you set a salvage value, you cannot go beyond salvage value. So that means your book value must always be equal to your salvage value. No less than its value. You can have it more and you can have it exact, but you can never have it fall below salvage value. So in this case, already with that rule right there, we have to actually be able to either change it, or once what we do is we're actually going to calculate it as if it was 2,000 and just write off those extra 200 as part of this 2,000. So in this case, you may have produced 2,200 items, but at the end of the day, your salvage value cannot, or your book value cannot fall below salvage value. So in this case, you're going to have to figure out what that number is, calculate it, so then it ends up at salvage value. Okay, so that's the rule there, that you cannot ever fall below salvage value. Now, of course, if your salvage value is 0, then great. You can keep going until it hits 0. But most cases, once you reach the end of its life, right, technically, it should start breaking down pretty easily and pretty soon. Especially machines that, if it's lasting for more than 7 years, you might need to take a look at it. Okay. All right. So now that we talked about just solving for depreciation itself, let's actually talk about how we actually journalize it. So in this very scenario, right, using the same table that we solved earlier, where we had for the first year, we had a total of 21 units produced that year. Okay, and we saw that the depreciation expense was $26.25. So that's exactly how we're actually going to depreciate it. We're going to have a depreciation expense account, and we're going to have what's called a contra asset account. So instead of taking it out from the asset, right, which is a big no-no, because due to that GAAP rule that says, no, you cannot devalue in a fixed asset right then and there. You can only devalue it when you sell or get rid of your assets. So in this case, we cannot take it directly out from my actual asset. So instead, what I have to do is I have to create what's called a contra asset account, which allows you to decrease the value of your fixed asset without actually devaluing the value of your fixed asset. Okay, so you create a contra account for this, and it's called the accumulated depreciation. Okay, now a lot of students also notice this. Wait, but there's an accumulated depreciation in your table. Okay, yes, there is, but in this case, that's not the same thing as the accumulated depreciation in the actual journal. Okay, but as you progress through each and every time you depreciate it, your accumulated literally is going to be your table is going to reflect your ledger account, while your journal, right, we learned this, right, a journal is just journalizing the transaction at hand. It isn't keeping an account balance. That's the difference between that. Okay, it's the same account, but it's essentially it's the way that we treat it. Okay, so in this case, right, this example here, we do the accumulated depreciation and depreciation expense for the 26-25. Okay, what about for the second year? Same thing here, right? We saw for the second year to be a total of 2,500. So that's exactly what we're going to do. We're going to journalize the depreciation expense and the accumulated depreciation for 2,500. And then again, because this is the second year, we're assuming that depreciation happens at the end of the year, which is December 31st. Okay. And that's how you journalize that. All right. Any questions here? Nope. Okay. So now this is where we're actually going to start talking about what happens when it comes to a point where we actually start placing things into services at a later date. In this case, right, we this example here says that on October 1st, we end up making a purchase for a machine for a total of $10,000, okay? And its useful life is 5 years, and its capacity of producing 25,000 units, okay? And it has a salvage value of 2,500, and it was placed into service on October 18. Okay, so how are we going to record the depreciation? Assuming, okay, that that we end up producing 250 units that year. Now in this case, right, we collected all the information. Now, if we follow the rules when we talked about the component number 4, which is what was the date that we placed into service? In this case, we placed into service as of October 18. Okay, so if we think about it, right, that means October, okay, and we are assuming it's the 18, which is definitely less than half of the actual month. So therefore, we make that as a determining factor to say that, hey, that means we're going to start depreciating as of November. Okay? So therefore, if I'm assuming I do my depreciation at the end of every year, that means for this year, I'm only depreciating for the month of November and the month of December. So that means how old is my actual asset? It's only 2 months old. And what's the lifespan on it? That means
5 years.
I can only depreciate it for only the 2 months because that's how much I used it, right? It has a lifespan of 5 years, but in reality, because it was put into service as of October 18, that's less than the month. So then I have to depreciate at start of November, and again, December would make it the end of the year. So in this case, right, how am I going to calculate this right here? So on the first year, it only produced 250 units. Okay, So let's go ahead and solve for the depreciation basis, rate, and expense. Okay. So in this case, right, my depreciation, go ahead,
Where they come from?
to
250. The 250.
the 250 is the units produced that year.
So where they come from? The unit produced 25,000. So you divide by, I don't know.
Okay,
To do that. Where they come from?
so let's just walk through it, okay? So again, so how do you solve for the depreciation basis?
Is the asset, the cost of the asset minus the value of the salvage,
Uh-huh.
value, no? So what is come from the 200?
The 250 is what you produced that year. So remember, this is the capacity, right? This machine can produce up to 25,000 units. In this case, when I depreciate it, I'm basically saying how many did it produce that year? And it produced only 250 units. Because I only put the asset into service for only 2 months. How much can it really produce? If you have a total of 25,000 units, how much can it produce in 2 months? It only gave me 250 units. Okay? So in this case, right, I'm going to solve for all of it. So again, should be 7,500 for the depreciation basis. Okay, divide that by the total of 25,000, which gives you 30 cents per unit that you produce. So in this case, 30 times 250 gives me a total of $75. Okay, because in this case, that's how much I use the machine. It only produced me 250 units in the course of 2 months. Okay, so in this case, right, it doesn't even matter whether I place it into service on X amount of dates, because at the end of the year, your manager is going to say, hey, this year or at the end of December, we end up producing X amount of units. So in this case, once again, it's not based on the time that you put it on. Your only main focus is that you're making sure that your capacity is met at all times and it doesn't go over and it doesn't go under. Okay, does that make sense? Okay.
Yes.
So again, this capacity, right? That means my machine can only produce up to 25,000 units. But because it has a lifespan of 5 years, right? That means I have 5 years to produce 25,000 units. Okay, but because I decided to place into service as of October and I do depreciation at the end of the year, right? I only produce 250 units. On average, right? If you take 5 years and you divide it by the 25,000 units, you should be producing at least 5,000 units per year. But in this case, that's not true because my asset's only 2 months old. How in the world can I produce 5,000 units in 2 months? So that's the only concept here that I want to point out here. But that's not the case. That's not always the case when we actually dive into the other depreciation methods. Okay, you're going to see something completely different the next time you look at something. Okay. So once again, we're going to journalize it as depreciation expense because this is the first year. First year, it's only been 2 months. So therefore, the next time you depreciate it, you're starting from January 1st all the way to the second year, which is going to be the December 31st. And that will consist of a whole year that asset has been placed into service. Okay? So again, You're going to journalize it just like this. And that is it. So, chapter review. We talked about depreciation and how it's consisting of 5 components, right? And we broke down each component, right, based on especially whether it has a salvage value or not. Okay, if it does, under GAAP, salvage value, there is no salvage value. And of course, if you're using GAAP, it's already predetermined what the estimated useful life is. Whereas if you're a sole proprietor, small business, you have leniency on that. Okay, we had talked about the depreciation methods that exist out there. Okay, we talked about the date that you placed into service. All right, and we even talked about how to journalize the depreciation. Okay, you're going to do a depreciation expense, and you're going to create a contra asset account to decrease the value of your asset without actually decreasing it, without taking it out directly. Okay. We talked about units of production. So here is the formula right here. Once again, the purpose of using units of production or activity based depreciation is to determine how much it's going to cost you, or in this case, how much are you going to depreciate it based on a capacity. Okay. All right. 30 minutes doing the exercise. Okay. And maybe this might make a little more sense to you. Okay. So let's go to question 1 through 3 over here. So questions 1 through 3. Okay, this is chapter 11.1 depreciation, units of production method. Okay. So number 1, you purchased a printer for $150, okay, with no salvage value, okay? Its useful life is 5 years, and it can produce up to a total of 10,000 pages, okay? And of course, you put this printer into service as of January 12th, okay? Now, assuming that we're calculating depreciation at the end of the year, okay, so let's go through and fill out this table right here. What did I buy? You bought a printer. Okay. How much did that printer cost me? $150. Okay. What was the salvage value on that? No salvage value. What is the estimated useful life? 5 years. What was the total amount of units that it could produce? It can produce 10,000 pages. And last but not least, when did you place this into service? January 12th. So what does that mean? If I placed into service as of January 12th, when do I actually start depreciating it? Yes, you depreciate it as of January, and because the assumption is that we are going to assume that we depreciate the end of every year, December 31st. So in this case, 1 full year will be calculated. So here in my table, I've already have preset numbers already here for you. So I said year 1, you produced 2,100 units. Year 2, you used 2,200. Year 3, you had 1,900. Year 4, you had 2,000. And year 5, you had 1,800. Okay. So let's go ahead and solve for the depreciation basis. What is my depreciation basis? $150, right? Because my asset cost minus salvage value, right? Asset cost is 150 minus 0 gives you 150, okay? What is my per unit rate?
1,
How is it 1?
100, 150 divided by 150, right? Or by 0.
Why? Where? What are you getting this 0?
But you can divide by 0, and the number divide by 0, but it's 0.
What's
I don't know. Or 1 or 0, I don't know. You divide by 150 or you divide by 0. You don't have any. Actually, the depreciation base is 150. So
okay? What's the formula for solving the per unit rate?
it's
You
is the depreciation basis divided by the unit product. Oh, so it's wrong.
okay? So what? So okay? No, you answered the correction, the right. You answered the question correctly. Okay, so I'm taking my depreciation basis and I'm dividing it by my total number of units produced. What number is that? How many units can this machine produce? 10,000.
10,000. 10,000. Yeah. So that's
Okay.
the mistake
So in
there.
this case, right? What is that number? If I'm taking $150 and dividing it by 10,000, how much is it going to be?
0.015.
0.015. Good. So that means it's going to cost me 1.5 cents for every unit that I produce. So if I produce a total of 2,100 units, right, and it's going to cost me 1.5 pennies, right? What's my depreciation expense for that year? So I'm going to go ahead and use my equal round here because I do have half a penny.
$30 and point five. $31.5.
$31, 31.5 cents, or $31.50. Right? So again, what's my accumulated depreciation? What's my accumulated depreciation for the first year? Good, because it's
31.50.
previous year's accumulated depreciation plus the current year's depreciation expense. In this case, I don't have a previous year. So that means it's going to reflect whatever my depreciation expense for that year is. Okay. Now, in this case, what is my total book value?
$118.5.
118.5. So if you do want to stop here and say, hey, I'm going to sell my printer now, at least you know it's obviously not going to be priced at 150 because you used it, right? You printed stuff. You've used the machine. But you know at least it's at least worth $118. At least. Okay? Not that you would get that money. You probably might get $100 out of it, but at the end of the day, you know that it's worth 118. Okay. So let's go ahead and journalize that first. Or actually, let's go ahead and just keep filling the table out, and then we'll do questions 2 and 3 later. Okay. So then, if that's the case, right? Let's go ahead and solve for the rest of the table. Okay. So if on the second year I end up producing 2,200 pages, okay. What's going to be my depreciation basis? Good.
150.
150, right? Because it's your asset cost, right? minus your salvage value, which gives you 150. And if you remember from our PowerPoint, you're going to notice that the depreciation basis stays the same. Okay? What about your per unit rate? It's going to be the same too. So, right, depreciation basis divided by the capacity of 10,000. You're going to end up with the same number here. Okay, and you said it's going to be the same all the way through. So in this case, I'm going to go ahead and move my decimal places over so you can see. Okay, so it's going to cost you it's going to cost you 1.5 cents. Okay, now here's the difference here. Because every single year, we're going to be producing a different amount of units. So in this case, I produced 2,200 this year. So what is going to be my depreciation expense for this year? $33. Okay, good. So then, all right. So in this case, what is going to be now my accumulated depreciation? Because now we actually have a previous year.
So it's
64.5. Okay. So then what is my total book value going to be for year 2? $85.5. Okay. So because you end up producing 2,200 on as of year 2, your asset has now significantly dropped in value. It's now worth $85. Okay. All right, let's continue on. Now that we've solved that year 3 and year 3, year 4, and year 5, it's going to have the same depreciation basis and the same per unit rate. What is the depreciation expense if I end up producing 1,900 units for year 3? $28.5. Good. So therefore, what's going to be my accumulated depreciation? $93. Okay, bringing my book value to be a total of $57. Okay, as of year 3. So it's got 2 more years left, right? So let's go ahead and do year number 4. In this case, I produced 2,000 as of year 4. So what's my depreciation expense going to be for year 4? $30. Good. Bringing my accumulated depreciation to be
$123.
123.
okay. Bringing my book value to be $27. So after using it for 4 years, it's now worth $27. Okay. Last but not least, I end up producing the 1,800 100 units as of year 5. Okay, so what is going to be my depreciation basis? 27.
27.
Okay, what's my accumulated depreciation? And therefore, my book value is 0, right? Which is exactly equal to salvage value. Okay. And that means we are done. So let's go ahead and do question number 2, where it says record the adjustment entry for the first year. So in this case, right, how do I journalize for the first years of depreciation expense?
So depreciation expense for and
Mm-hmm.
accumulated depreciation
So we have,
for 31.5.
good, for 31.5. Mm-hmm.
Depreciation.
So we have depreciation expense, and we have the accumulated depreciation. Okay, for the total of $31.50. Okay. Then question 3 says record the adjustment entry for the second year. So let's take a look at our second year. How much did we calculate for our second year for our depreciation expense? We paid it for we depreciated for $33. So the journal, okay. How do I journalize for the second year? Okay.
Our depreciation expense would be the 33 for a debit, and then accumulation depreciation would be
Good.
33.
Yep.
The,
Excellent. And that's
I don't understand because can you if the accumulated depreciation is 64.5, why I know that the depreciation expense is 33, but the accumulation depreciation is 64. What you write here, what
be
we write before. So I don't understand
okay,
what's
because
important there.
in the table, I talked about this earlier. The table reflects your ledger. This is the journal. The ledger calculates the total, right?
All right.
So if I
Yeah.
and that's correct, right? If I depreciated this year for
Mm-hmm.
33, then yes, it's 33 because I don't have a previous year. But if I depreciate it for an additional 33, then I'm at the 64. If I depreciate 28 more, then I'm up to 93. So the accumulated depreciation in your table is what reflects in your ledger. Okay? And in this case, we're just focusing on journalizing. So so
That's
if
what
I
I
look
do.
at this and I
Thank you.
do it like a ledger, right? I would have these two entries for 31 and for 33 to get my table to look like it's 64. Okay? Yes. Okay. All right, good job. Okay? So let's go ahead and finish up this last. Go ahead, yeah.
Okay.
Let's go ahead and finish up
Sure.
this last. Yeah.
Can I ask you something? The ledger we saw the ledger on many. Yeah, it's the ledger about the ledger. When the journal, I understand. You write how on many occasions we saw the ledger. For example, for the bad debit. Now you have a specific way to do the ledger, or is how
The
to
ledger
understand it?
is exactly like the journal.
Because when we saw the ledger of many different, mhm,
What do you mean?
yeah, balance. That's I know. I understand. Remember for the how do you call that? For the register and for the petty cash and for many,
Mm,
we saw the ledger. And
okay.
the ledger is look totally different for the journal. It's reflect the same.
Okay, so remember, you need to journalize first, right? That's step 3. Step 4 is posted to the ledger. So journal and ledger, they're exactly identical except one of them you're just doing the daily journal, the daily transactions with this is the journal right here. But when I post to my ledger will give me an account balance. That's the only difference between the ledger and the journal.
Yes. Mm-hmm. It reflect the same. That I get it.
No, it does not
Yes.
reflect the same because one of them has an account balance while the other one
Uh,
doesn't.
yes, I have that. It doesn't have it. Yeah, it's all the what you journalize on one spot with a balance. No,
Yes.
that's a ledger.
So in this
So
case, right,
mhm.
I'm not I'm not looking at account balances. I'm just looking that a transaction has happened. Okay, so that's the difference between a journal and posting to the ledger is that a journal only journalizes the transactions that happen at hand, where posting to the ledger is where you're trying to find out what the account balance is after the transaction has happened. Okay? Okay, so in this case, because I'm just teaching you just to primarily just practice journalizing, because when we dive into the fictitious business, you'll understand how to use the general ledger. Okay,
Mm-hmm.
all right. So let's go ahead and finish up questions number 4 through 6. So again, this is the last thing that we're going to do. So if you could spare me 10 more extra minutes, then you can go early. All right, so number 4. Okay, this time you purchased a truck for $36,080, which includes all fees with a salvage value of $5,000. Okay, and its useful life is 7 years, and it has mileage up to 150,000 miles. Okay. So then here, you put this truck into service on August 25th. Okay? Assume that the adjustment entries are made at the end of the year. So in this case, right? Let's fill in my information. What did I buy? We bought a truck.
Track.
Okay, how much did the truck cost me? 3680. Okay. What was my salvage value? 5,000. Okay. What was the estimated useful life? 7 years. And how many miles can this truck go? Good.
150,000.
And lastly, what was the date that we placed into service? August 25th. So when do I actually start depreciating it? The following month of September. But in this case, right? Let's take a look. So the first year, I only drove 10,000 miles. But the second year, I ended up driving 25,000 miles. Okay? So here, you put it into you place into service in September, right? September, October, November, December. So in 4 months, I drove 10,000 miles. Where opposed, if I drove for a whole year, it was a total of 25,000 miles. Okay. So let's go ahead and take a look at this. So how do I solve for my depreciation basis? How do I solve for my depreciation basis?
We take the price of the
Mm-hmm.
3680 and then we subtract the um, the cost of the assets. I mean,
Good.
the
So in this
salvage value.
case, what is that total? 3180. Good. Right? Now, of course, if we knew the rule, right, that means depreciation basis is going to stay the same throughout all 7 years. One more. Okay. Now, what about the depreciation rate? How do you solve for the depreciation rate?
We take the 3180 and divide it by the
Good, right? We
150,000.
take the rate and we're dividing it by the capacity, all right? I'm sorry. We're taking the depreciation basis and dividing it by the capacity, which then gives you how much?
2.072.
Yep, that's correct. So, which in this case, we know for a fact that this is also going to stay constant all 7 years. Okay. So, in this case, right, I definitely need to use my equal round because I have 207. Okay. So, in this case, what is my depreciation expense for year 1 if I drove 10,000 miles? $2,072. Okay. So I have a depreciation expense for $2,072. Okay. Which then, because we know this is the first year, which is going to be the same. So then what is going to be my total book value? What's my book value for the year, for the first year?
$7,928.
Okay, what did you? Okay.
10,000. 10,000 minus. No,
Okay.
it's a mistake. Sorry.
So in this case, we take our asset cost of the 36,080, and we're going to subtract out the 2,072 to give me a total of 34,008 even. Okay. What's the depreciation expense for year 2 if I drove a total of 25,000 miles? Good.
5,180.
So then what's my accumulated depreciation if I have a previous years of the 2072 plus my 5180? What's my accumulated depreciation?
7252.
7252. Okay, bringing my book value to be
Is that right?
what did you get?
18,748.
No, that's not right. Okay, so what number did you use?
I was trying to copy my formula. Equals. I calculated it wrong. 36,080 minus the 7252. 28.
Good, 28,828. So in this case, if you're self-referencing, what I did is because I use absolute self-referencing, meaning like I want to use this number only. So that's what I did. I locked it with numbers, signs, okay? And that's what's called an absolute self-reference, meaning I only want one cell and one cell only. Where relative is where I want to move across the board and calculate that way. That's why this right here, this formula right here, that's why this section right here, the second half of my formula is that because I'm moving across down the row. Right? So that one is relative. Okay. Okay. Good. All right. So what's my depreciation expense for year 3 if I drove 19,000 miles?
I got 3,936 and 80 cents.
Good. Therefore, bringing my total accumulated depreciation to be
Um, 11,188.
good. So that brings my book value to be
24,891.20.
excellent. Okay. So what's my depreciation expense for year 4 if I drove 20,000 miles? Good.
4,944.
Bringing my accumulated depreciation to be
15,332.
good. Okay, which then makes my book value become
20,747.20.
all right. All right, 3 more years left now. All right, so in this case, how much is my depreciation expense if I decided to drive 18,000 miles on the 5th year?
$37,2960.
2960, good. My accumulated depreciation is going to be good. Bringing my total book value to be
17,1760.
So then what's my depreciation expense if I end up driving a total of 22,000 miles as of year 6? On the 6th year. Not 4,558.
2,000. Sorry.
So then what is your accumulated depreciation?
23,600.
Good. Bringing your book value to be
12,459.
good. So here on the 7th year, I decided I drove 26,000 miles. So what's my what's my depreciation expense? Good. Bringing my accumulated depreciation to be
$29,008.
bringing my book value to be
$7,072.
Now let's take a look at this. We reached the end of our table. Now we reached 7 years. However, I didn't reach the end of my asset's life. Okay? Why is that? Why is that? How old is my actual asset? All right. When did I place into service? August 25th. And you said we're going to depreciate September, right? September, October, November, December. My asset's only 6 and 4 months old. It still has a useful life of 8 more months. So therefore, yes, this is where the occasion is that yes, you can have an 8th year because the way that I placed my asset into service was definitely it wasn't a whole year old in my first years of when I started depreciating it. So in this case, right, how much more can I actually depreciate my my asset for the remaining 6 months or 8 months? Okay, again, if you want to solve for it, you can. All right, because what the end goal here is that we know that our depreciation basis, right, and our depreciation rate is going to stay the same, right? But the one rule that we need to know is that at the end of its life, it has to equal a total of 2,000. What was it? 2,000. What was the salvage value? It has to be 500. So in this case, right, if we take 5,000 minus this 7,072, right? How do we get to 5,000? Well, that's straightforward, right? We just simply subtract out 2,072. I don't know why my formula is not working here.
you calculate the remainder miles that you have, you can find it
I
too.
I just put this. Sorry, I put this in the wrong box. It's supposed to be.
No, you see, if you calculate the number of miles that they did, we have a 150,000 miles that they say that we did. So every year you subtract, you have the miles that they did. If you subtract to 150,000 the miles that they did, then we can find
Excellent.
the
Excellent.
remainder.
Yes. That is
Okay.
another way
Yeah.
you could solve
Okay.
for it. Exactly. I was showing you one way, but yes, that's exactly absolutely correct. Right now, I only have a total of 140,000 miles used. So in order to get to 50,000, right, I need to drive 10,000 miles
Another
more,
10,000.
which in this case, if I calculate that, right, we know what that is by looking at a very first line up here. 10,000 miles gave me 2,072. So in this case, yes, I can work forwards as well. I could take my total amount that I drove. I just do equal round. Okay, I could take the total amount that I drove, which is we know that we have to meet our capacity to give us 2,072, which again, you add your accumulated together, gives you your depreciation basis, right, of 3180 to give you your ending balance at 5,000. Excellent. So yes, I was showing you to work backwards, but yes, you absolutely can figure this part out to solve forward as well. And at least we know that our 8th year, of course, we didn't drive it for the whole year. We drove it up to the end of its 8th month. Okay. So once again, we're going to be journalizing. It says right here that go ahead and do the adjustment entry for the first year, assuming adjustment entry was done on December 31st. So in this case, right, what's my journal going to look like? What's my journal going to look like?
Depreciation expense and accumulated
Good. So
depreciation.
then for the first year, how much did I end up calculating my depreciation expense to be?
2072.
2,072. And yes. And again, last but not least, the third question says go ahead and record the adjustment for the second year. So in this case, what was my total amount for the second year of depreciation expense?
5180.
5,180. Good. All right. Excellent. Any questions? All right.
No.
So this was units of production, okay? We definitely have more extra room to practice this depreciation method again. Monday we're going to practice another round of